Let me now bring on board a very special guest, Jonathan Garner, Managing Director and Head of Global Emerging Market Strategy with Morgan Stanley. Jonathan, it's always a pleasure to have you back on ET Now. Thank you for joining us. So Jonathan, let's address the moot point.
Good morning.
Exit polls indicating that NDA-2 is coming back to power. From an investor standpoint, is the NDA-2 victory already in the price? Because markets have already seen a run-up of 5% plus in last 1 week.
Yeah, so we obviously don't have the result. The votes are still to be counted, but the exit polls certainly did cause that move higher that you mentioned. I think if we step back a bit, we are overweight India. We were overweight, before this week. In terms of our recommendations, we're recommending that clients rotate out of China, where we have a negative catalyst in trade tensions between the US and China. And we think that the Indian economy is primed for a cyclical upturn in the post-election environment. We think that interest rates can remain on a downward trajectory, in particular as the US Federal Reserve has changed its view. And we think that the valuations on a relative basis to other emerging markets are quite attractive. So we are overweight India, and we would continue overweight India here.
You know, now that exit polls have squashed all the doubts over the political leadership, and I hope tomorrow as well we see them getting only replicated, if not bettered, what would you like to see from the NDA if it were to come back to power in terms of economic reforms? I know you just talked about the interest rate trajectory, but what more from the finance ministry, what more from the government in terms of reforms?
Well, I think a re-energized emphasis on infrastructure investment, on land acquisition reform, on the ease of doing business survey globally, the deregulation and speeding up the regulatory functions of the state. These have all been elements of the government's agenda. And certainly very vigorously procured in the first phase of government, but perhaps demonetization and the shadow banking issues that India's experienced have sort of detracted somewhat from that initial reform agenda. So we'd like to see that re-energization of reform. Yeah.
I would argue that NDA-1 enjoyed majority in both the houses of parliament. Whatever decisions they wanted to take, they had the political freedom and also the number advantage. What do you think NDA-2, if we assume that they come back to power with full majority, will be able to achieve in 1 year or 2 years, which NDA-1 was not able to achieve?
Well, I think the achievements in relation to bringing the fiscal deficit down and working with the RBI to bring the inflation rate down, they've been very important achievements. And if you look at the inflows to domestic mutual funds, I guess the sort of financialization of the economy is hopefully the beginning of an upward trend. So that's another important development from the stock market perspective. So India's become less reliant on foreign investor flows than it was in the past. And of course, one consequence is also that the current account deficit has come down with the fiscal deficit, so that the overall macro balance is a very important part of the improvement that we've seen in India.
Jonathan, if I could just, quote a classic adage, which is that Rome was not built in 1 day. And 5 years is not good enough to turn around an economy like India. Which are the key reforms which do you think NDA-1 implemented will be able to kickstart a new cycle per se? You mentioned banking, but anything else which you think has been implemented by the current government, or when I say current government, NDA-1 will see light of the day?
We've seen, for example, the insolvency reform. That's very important for recycling capital in the economy. So I think a lot of the groundwork has been laid. I don't think in particular we need some sort of dramatic measures. It's more that the environment now, particularly with this structural reduction in real interest rates, should allow private sector capex to come forward. That's been very weak up to now. And the consumer to come forward. And again, it may be to India's advantage, this trade and tariff situation between US and China. We can already see some large contract manufacturers in Taiwan and elsewhere starting to relocate plant into India. So I think India's geopolitically very well positioned to benefit at this particular juncture. it's not the only country which that is true of. For example, we're also overweight Brazil, which stands to benefit from increased agricultural trade with China, as U.S. agriculture is clearly going to be compromised by what's going on. But I think India has quite interesting optionality in relation to the trade and tariff dispute between U.S. and China.
I'm intrigued to know, where is it that you find valuation comfort within Indian markets? Because, while we may be rejoicing, just yesterday we hit an all-time high on the indexes, banks are doing so well. But again, it's a very restricted, very isolated move within Indian equities. Only those 8-10 stocks are the ones which are holding the indexes up.
Yeah, so if you look at a trading PE basis, the market has been quite a high valuation in the mid-high 20s, but that's because ROE is cyclically depressed. So we would prefer to look at a price book relative to other emerging markets, which is much more towards the low end of the range, round about where we were in 2013. So remember, for someone like me, we're always looking at the relative opportunity set as much as the absolute. So that is quite an interesting feature for us. Broadly, in terms of what my colleague Ratan Desai is overweight on private sector financials, consumer discretionary, and part of industrials, continuing quite cautious on telecoms and some of the exporting sectors. Do remember that when we look at the outlook for the rupee, it's actually quite bullish on our side. We think we've already obviously seen the rupee strengthen somewhat this week, but we think the rupee can strengthen down to the mid-60s to the US dollar going forward. So that's obviously quite a bullish outlook for owning domestic stocks rather than export stocks.
Do you get a sense that there is a wall of money which was waiting for the election outcome, and once clarity emerges tomorrow, and if it is a clear mandate, flows could automatically come back to India?
Well, we certainly have been recommending very aggressively in the last 2 weeks this switch out of China into India, but also into Brazil, Australia, and Japan. So we did see very, very large inflows in the first part of this year that were going to the China market. But now with this resumed trade tensions between the US and China, I think this election result has come at a very interesting time when there is global money that can reallocate towards India.
The sudden slowdown which the Indian consumer space seems to be experiencing, it started with autos 2 quarters ago, and now it's getting more and more pronounced even in consumer staples and durables.
Yes, that's right. So the economy has really been quite weak. As to the diagnosis of that, I think we've had a sequence of shocks from demonetization to the teething issues around GST reform to shadow banking, and then obviously the Fed hiking rates last year. So the Indian economy has, on the consumer side, been quite weak for some time, and also on the private capex side. And it's that turnaround that we're hoping for after the election. Obviously, we would expect foreign direct investment to start to move higher as well. So, yeah.
Right. But Jonathan, do you buy this decline in consumers or not just yet?
Yes, we do. Yeah.
Okay.
Yeah.
Now, Jonathan, if a client walks up to you and says, look, Jonathan, I want absolute return ideas. I can digest a 10% downside, maybe a 15% volatility, but I'm looking for compounders where my money can grow at 15-18% for next 3 to 5 years. What should I be buying then?
Well, I'm afraid for this interview, we're not permissioned to talk single name stocks, so I gave you the sector recommendations. I do think, the financial sector broadly can do very well as we get lower real interest rates. Typically what you see is financialization of the economy. People take on more mortgage credit. We start to get a more developed real estate sector, gives people collateral in terms of their personal borrowing. Obviously also offers opportunities for financials. So that core overweight financials is a key part of our thinking.
Jonathan, really appreciate your time and thank you for joining us.